Welcome back to TalkTickers.
Great to be diving into another one.
Yeah, today we're tackling Realty Income's first quarter 2025 earnings call. Just listen through it.
Quite a bit going on there. Strong start to their year.
Definitely. Big picture, looked like a solid quarter. Really showed the resilience they talk about in that global portfolio.
Yeah, that diversity seems to be paying off.
Right.
And the numbers reflect that, I think.
So let's get into those specifics. Adjusted funds from operations, AFO per share. What did that look like?
Right. So AFO per share grew 2.9% compared to last year, landed at $0.76.
Okay, steady growth. That's what you like to see from that.
Exactly. Consistent. And then you add in the dividend yield, which is, pretty attractive at 6%.
Right.
So you combine those, and their total operational return for the quarter was actually 8.9%.
Nearly 9%.
Yeah.
Not bad at all. And they weren't just sitting still, were they? They put capital to work.
Oh, yeah. $1.4 billion invested in Q1.
That's a significant number. And the yield on that?
That was interesting. 7.5% weighted average initial cash yield.
Okay, 7.5%. And how did that compare to their borrowing costs?
Well, that's the key, right? It generated a spread of 204 basis points over their short-term weighted average cost of capital.
Nice, healthy spread. Shows good capital allocation.
Definitely. And what stood out was how they deployed it. Seems like 72% of that volume came from just 5 big transactions, over $50 million each.
So they're able to make sizable, efficient moves.
Yeah.
Where did most of that money go geographically?
Europe took the bulk of it this quarter. That was 65% of the total volume. That's $893 million.
Wow, almost $900 million in Europe. What kind of yield were they getting there?
Average initial cash yield was 7% in Europe. And they were focusing pretty heavily on retail parks.
Retail parks, okay. UK and Ireland, was it?
Primarily, yeah. UK and Ireland. And the strategy there seems pretty clear.
Which is?
They're buying assets where the rents are currently below market rates. And crucially, the acquisition costs are below what it would cost to build something similar today.
So buying below replacement cost and below market rent sounds like a value play?
Exactly. They see an opportunity to, bring those rents up closer to market levels over time, especially as they attract bigger retailers looking to maybe reposition or expand.
Makes sense. So it's the upside there.
Right.
What about the U.S. side?
They were active in the U.S. too, just not quite as much volume. $479 million invested stateside.
And the yield, higher or lower?
It's actually higher in the U.S.
Yeah.
An 8.3% weighted average initial cash yield.
Interesting. So higher yield in the U.S., but more volume went to Europe. Why do you think that was?
Well, based on their comments, it sounds like they saw plenty of opportunities in the U.S., but maybe felt their risk-adjusted returns were slightly more compelling in Europe, at least for this first part of the year. They were being selective.
So prioritizing risk-adjusted returns over just chasing the highest yield.
Seems that way. And it ties into their broader point that they feel the market sometimes offers a bit of a discount on these high-quality net lease assets, especially given their international reach.
Right. That global capability is a key differentiator for them, isn't it?
For sure. Geographic diversification. Okay, so let's talk about the existing portfolio. It's huge, right?
Massive. Over 15,600 properties. Spread across, 91 industries?
Yeah.
Nearly 1,600 clients.
Yeah, really diverse. And the client base itself looks pretty well positioned.
How so?
Well, over a third, 34%, are investment grade rated. And the average rent coverage is strong, 2.9 times.
Meaning tenants are earning almost 3 times their rent.
On average, yeah. Gives them a good buffer. Plus, looking at their retail tenants, over 90% of that rent comes from businesses that are either non-discretionary, low price point, or service-based.
Stuff people need or use regardless of the economy. More defensive.
Exactly. Should hold up better in tougher times.
What about occupancy? Did that hold steady?
It ended the quarter at 98.5%, which is technically a slight dip from the previous quarter, but still really high, above their historical median.
Okay, 98.5% is still very strong. And when leases came up, how'd they do on renewals?
Pretty well, it seems. They had 194 leases resolved, and the rent recapture rate was 103.9%.
So they actually increased rents on average for those spaces.
Yep. And 92% of that activity was renewals, keeping existing tenants. They also mentioned minimal use of lease incentives, which is a good sign.
So just tenants want to stay. Were they selling any properties too?
They were. Active portfolio management, sold 55 properties, brought in net proceeds of $93 million.
Okay.
And interestingly, $63 million of that came from selling vacant properties, so clearing out non-performers.
Good discipline. All right, let's shift to the balance sheet and their outlook. How are they looking financially?
They sound confident. emphasized being well capitalized, having enhanced liquidity, and benefiting from their sheer scale.
And the guidance for the year, any changes?
Nope, maintain their 2025 AFO per share outlook. That's $4.22 to $4.28.
Okay.
Important note, though, that guidance includes an expectation of about 75 basis points of potential rent loss, mostly tied to some prior M&A activity.
So they've baked in a buffer for potential issues.
Seems so. And they also mentioned not expecting any material impact from, current geopolitical uncertainties.
Good to hear. And their investment target for the full year, still $4 billion.
Still targeting $4 billion for 2025. But they did hint they could potentially increase that if the right deals come along.
Especially if their cost of capital is favorable.
Right. And they actually mentioned their short-term weighted average cost of capital has decreased since they initially set that guidance.
Okay, that helps. How are they funding all this? Did they talk about recent capital markets activity?
Yeah, they did. They closed a $600 million 10-year unsecured bond offering in early April. Got a 5.34% semi-annual yield on that.
Decent rate for 10-year money.
Mm-hmm. And they also recast and expanded their big multi-currency credit facility. It's now up to $5.38 billion. Gives them a lot of flexibility.
And their leverage metrics, how do those look?
Seem pretty comfortable. Net debt to annualized pro forma adjusted EBITDA is sitting at 5.4 times.
Okay.
And their fixed charge coverage ratio is strong at 4.7 times. Plus, very little exposure to variable rate debt, just over 6%.
So, mostly fixed rate debt, good coverage. How does that $4 billion investment target get funded then, roughly?
Good question. They laid out a potential mix. They've got about $265 million in outstanding forward equity already lined up.
Okay. Equity raised, but not yet issued.
Right. Then there's their ongoing free cash flow after dividends. That's roughly $650 million a year, which acts kind of like equity capital.
Mm-hmm.
Then they expect to raise around $2.2 billion in debt and potentially maybe $750 to $800 million in new public equity. That's before considering any proceeds from property sales, which could reduce the need for new equity.
Got it. So a mix of sources. Beyond the core business, any interesting strategic moves happening?
Yeah, a couple of things. They launched their U.S. Core Plus Fund. That's a private capital initiative.
Moving into the private fund space.
Exactly. Targeting institutional investors. They said early interest has been positive. It's a way to, diversify their capital sources beyond just the public market.
And maybe generate some fee income eventually.
Potentially, yeah. Broadens their capabilities. They also did an interesting opportunistic loan. Yeah, to a private global developer in the data center space down in Virginia.
Data centers, okay.
The idea seems to be building a relationship that could lead to future property ownership. And the ultimate client using the data center is apparently a major hyperscaler.
So a foot in the door for future data center deals with big tech, potentially.
That seems to be the angle.
Yeah.
And sticking with strategy, back to those European retail parks.
Right, the below market rent strategies.
Yeah, they elaborated a bit. The goal is clearly to capture that mark-to-market upside when leases renew, and also by bringing in better tenants to sort of reposition the assets.
Have they seen results from that yet?
They mentioned initial yields were north of 8% on some earlier deals, and they've seen significant cap rate compression since they started investing there about 3 years ago. Meaning
values have likely gone up?
Exactly. They estimate current rents are maybe 5-6% below market across those parks. Retail parks are now about 10% of their whole portfolio, mostly UK and Ireland, roughly $4 billion invested there.
So a significant bet that's showing early promise. How are they addressing rent growth overall, besides just mark-to-market?
Well, some sectors like industrial and data centers have more organic rent bumps built in. But yeah, the European retail park strategy is a big part of their plan for driving internal growth, too.
Okay. What about that planning investment, the indoor farming company? There was news about restructuring there.
Yeah, they addressed that. They seem to believe Plenty will come out of the restructuring stronger. The focus now is apparently strawberry production in the facility really owns.
Strawberries, okay.
2 out of 12 bays are operational, and they have a takeout agreement with Driscoll's. Realty's invested about $40 million total.
And if it doesn't work out?
They said they have a downside plan. They could potentially convert the land and building into a distribution center or maybe even a data center site.
Contingency planning. Good. Do they give any updated metrics on their retail tenant health?
Just reiterated that average EBITDA to rent ratio for retail is 2.9 times, median 2.7 times. Still solid coverage.
Mm-hmm. And they mentioned being selective in the U.S., passing on some deals.
Yeah, they specifically said they passed on some higher yielding U.S. opportunities because of concerns about downside risk or tail risk.
Yeah.
Things in more discretionary sectors maybe, or operators with weaker balance sheets. They're really sticking to their knitting with non-discretionary retail and strong operators.
Got it. What about that slight dip in occupancy? Any concerns there?
They said it was expected and basically in line with their outlook for the year. Vacancies, including some Family Dollar assets they sold vacant, have largely been dealt with. They highlighted strong renewals and rent recapture at Dollar General and Dollar Tree.
Family Dollar is still a watch item, though.
Seems like something they're keeping an eye on, yes.
And the bad debt forecast, still 75 basis points for the year.
Yes, they maintained that forecast, although actual recognition in Q1 was apparently a bit lighter.
Okay. Anything else on the deal front? Any hints of larger transactions?
They did mention they're seeing discussions around larger portfolio transactions heating up, so that could be potential upside to their investment guidance if something lands.
Interesting. One more detail, ZIPS Fitness. I remember that was maybe a watch list item before.
Yeah, they gave an update. All ZIPS locations were renewed. They did negotiate a rent adjustment, resulting in a 94.3% recapture rate, but they said they got higher internal growth baked in and longer lease terms out of it.
So a resolution there. Any other geographic notes?
Just a mention of Poland as a country of continued interest for potential European expansion, citing its NATO membership and strong economy.
Okay, Poland on the radar. Right, let's move to our This Is Not Financial Advice segment. Time for some outrageous but plausible trade ideas based on all this. You go first.
All right, so idea number one. Given Realty Income's focus and apparent success in these European, specifically UK retail parks, they even mentioned being in maybe the 7th inning of their investment cycle there.
Okay.
What if you considered a long position in some UK-focused REITs or maybe even retail sector ETFs over there? The thinking is, if Leela Stray can unlock value by actively managing and repositioning these parks, maybe others can too, or maybe the whole segment gets repriced.
Kind of a contrarian bet on UK retail resilience, piggybacking on Realty's strategy.
Exactly. You're betting that their ability to spot these below-market rent opportunities and fix them up isn't unique, or at least that the tide lifts other boats in that specific niche. It's betting against the often gloomy view of UK retail.
Okay, plausible, if a bit bold. My turn.
Yay.
Idea number 2 focuses on that private capital move, the U.S. Core Plus Fund.
The diversification play.
Right. So really expect this to eventually generate fee income and potentially reduce their need to constantly issue public equity for growth. So how about a paired trade? Go long Realty Income, betting the market eventually rewards this diversified capital strategy with maybe a more stable valuation multiple.
Yeah.
And simultaneously short a comparable net lease REIT that hasn't diversified its capital sources like this, one that's still heavily reliant on the sometimes volatile public equity market to fund its growth.
So betting on a valuation divergence based on capital strategy.
Exactly. You're playing the potential arbitrage as the market maybe starts to appreciate the strategic advantage really might be building with these different pools of capital.
Interesting angle. Capital structure arbitrage in the REIT space definitely fits the outrageous but plausible criteria.
All right, that wraps up our deep dive into Realty Income's first quarter 2025 earnings call. We've hit the results, the strategy, the outlook.
Lots of moving parts, but a pretty clear picture of steady execution and strategic positioning.
Absolutely. And remember, everyone listening, these insights and trade ideas are just food for thought based on the call. Definitely not financial advice. Do your own homework.
Yeah, what really stands out is how proactive they seem, right? Both in finding investment niches like European retail parks and in evolving their funding strategy with the private capital initiative.
It feels like they're trying to stay ahead of the curve, which leads to maybe one final thought for you to chew on.
Lay it on us.
As really navigates these different global markets and taps into both public and private capital, how might this kind of blended approach start to reshape the traditional models we see in real estate investment more broadly? Is this the future? This mix of public REIT structure with private capital arms?
Good question. The lines are definitely blurring. Something to watch.
Definitely something to watch. Thanks for tuning in to TalkTickers. We'll catch you on the next deep dive.